At this point, I'd like to hand over to David Levinson as he talks to Ben Fitchew about what's been going on in the Global Behavioural Fund.
Thank you very much, Rob. As Rob mentioned, my name is David Levinson of Red Group Investments, and I'm joined on the line by Ben Fitchew, Portfolio Manager at Ardevora Asset Management. Ben, thanks so much for joining us. I think it's been 3 months since we last saw you.
Nice to see you again, yes.
Of course, a lot has happened in the markets since then. For those that are familiar with Ardevora, they run an investment process built on CEO behavior, and importantly, the strong influence that CEO behavior can have on both the behavior and actions of those of investors as well as analysts. And historically, if you look at CEO behavior, there tends to be quite a decent link between investor behavior and what CEOs are doing. Ardevora run a global equity portfolio, bottom-up stock pickers, and essentially what you end up with is a diversified portfolio of both growth and value stocks. So Ben, I'd like to bring you in here. I'm going to skip on to the first slide, which the audience may well be quite familiar with. It shows the tilt in the portfolio between growth and value. This is, from my understanding, largely informed by the opportunity set and the current environment. So in terms of what's happened in the last quarter, maybe you could talk us through some of the thinking behind the curves and numbers that we're seeing in front of us now.
Yeah, that's right. So you can see that obviously this sort of red line tracks the sort of proportion of growth stocks, and then the green line is the proportion of sort of value opportunities. And you can see, just for the sort of context, the long-term history was obviously it was tilted towards value until sort of 14, 15, and then we had this long period where growth stocks sort of were the sort of majority of our portfolio. And then you've seen, you know, in the last sort of the back end of 2021 and then into 2022, that we've had this sort of increasing tilt to finding value stocks, and that is in a number of interesting areas, which I think I touched on, or at least I hope I did last time. Energy, financials, materials, and in particular these sort of areas that where we've seen this sort of long-term restructuring and a lot of investor anxiety. So to your point, your actual sort of question, rather than the long-term history, what's been going on recently? Well, we've been doing a number of things the last quarter. We have been finding some laggard, sort of predictable analyst bias growth stocks. So not out and out growth, but more stable, defensive, predictable businesses. So the green line is no longer shooting up so much. It's still relatively high at over 60%. And the red line is we've found some opportunities in sort of stocks that are, I can explain what kind of businesses they are. They're relatively predictable, stable businesses, but that they're looking sort of relatively cheap. They've got a reasonable amount of what we call skepticism around them from the investor side, and we believe that they will be able to beat their plans over the next 6 to 9 months, and should be relatively insensitive to any kind of macro noise that we expect to coming up. I'll give you a little flavour of the types of stocks that we've been buying, if that would help. Yeah. So we've bought some healthcare names: Eli Lilly, Merck. This is an area, so pharmaceuticals is an area that we, generally speaking, not owned an awful lot of stocks in pharmaceuticals over the last 10 years, the life of the fund. And that's partly because there's been this long-term sort of interesting, challenging period for pharma where they've had a lot of patent cliffs. The R&D efficacy of traditional pharma has been really challenged by the emergence of effective biopharma, we would say. But Eli Lilly, Merck, but also Novo Nordisk, which we also own, beginning to show evidence that they have very strong franchises, and they have strong franchises in diabetes, but also emerging ones in obesity drugs and in Alzheimer's. Merck, slightly different. It has a sort of blockbuster drug, Keytruda, which is significant in oncology, so for treating cancer, and that has a lot of different applications. So those are interesting businesses, interesting kind of new theme that's emerging for us there. But also we bought some more sort of traditional kind of defensive names, Tesco's, which is obviously, you know, a defensive retailer, so a sort of food shop, and Coke, and we also have Pepsi. So types of businesses still have investor skepticism around them. They haven't done particularly well, as in share price wise, running up to our getting interested in them, but they look relatively predictable and able to control costs, but also have pricing power. So generally speaking, what we've been finding over the last quarter are those types of businesses, or as I touched upon last time, I think, we've bought Netflix and Meta, which obviously they are not staples, but they are certainly businesses where there's a lot of anxiety around them right now because of what's going on in streaming for Netflix and what's going on in social media and the emergence of TikTok for Meta. So hopefully that gives you a sort of sense of where those green and red lines are trending. I would say they sort of topped out where they are, finding interesting opportunities in slightly different kinds of stocks right now.
Okay, and just very quickly, I guess the portfolios, as we can see, they're a little north of 200 stocks. A reminder to those that have dialed in, portfolio equally weights all the counters. So if you've got 200 stocks, it's roughly about 50 basis points market value per share in the portfolio. And the one interesting thing is, Ben, is the clear sign is obviously at the start of 2022, you saw kind of a lowering of the growth side, adding a little bit more on the value side. That's very clear. In the last quarter, maybe it's less radical optically. Is this a matter of, or a case at least of, in Q2 you did the majority of your positioning and you're quite comfortable with what you had? Or is it the names that you mentioned now, you're actually swapping out of certain names recently and there actually has been a degree of turnover in the fund?
There hasn't been a lot of, so I wouldn't say there was a lot of change to the overall sort of direction of the portfolio. I think the major changes we would say that sort of occurred were really around from that January to sort of June period. So it was really the emerging new themes for us in energy and materials, which is a kind of which really came into the portfolio. Whilst this is more like finding some incremental new ideas in certain areas, I would say. So the direction of the portfolio, I would say, has changed. Most of that change has been in the first part of the year. So to your question, not radical changes. We're very comfortable, I think, with the overall shape of the portfolio. And I can talk about positioning and kind of outlook if you want, but we can do that.
I think I don't want to jump the gun too much. We might say that there might be a slide at the end of it. But I mean, you've touched on some of the names already. I'm just going to flick across to these are the top contributors in the last quarter. Audience may be familiar with some of these. You briefly mentioned Netflix earlier. Maybe talk us through some of the reasons behind these positions and how they've done.
Airbnb is a new position as well. I can talk a little about that. DBS Group is a Singaporean bank. We generally speaking, banks have come in over the last 2 years for us in the portfolio. So that's a kind of new theme on a 2-year view. DBS Group is an interesting one because Singapore is obviously a very sophisticated market. It's one where this bank is sort of doesn't have the tech debt of a lot of banks struggle with. And that means that it has a very clean operating model, relatively low costs, and it's basically benefiting from a sort of relatively benign environment for net interest margins. So it's surprising on net interest margins, and loan growth and all of that kind of thing is basically absolutely fine for us. So it's basically a strong, growthy kind of bank in an area that Singapore within Asia doesn't look risky. So it's got the environment behind it, and it looks different to its peer group. So that is basically just been able to surprise in the way that we had hoped. If I pick off Cheniere Energy, its ticker is LNG in Bloomberg, so that gives you a sense of what it does. It basically processes gas and liquefies it and then sends it across the world to places that don't really have LNG. And LNG is kind of a global market, but lots of the gas is kind of stuck in certain places. And so there's the build out of LNG processing and kind of transmission assets has taken a while. They're very, very long cycle, massively capital intensive projects. Cheniere is basically a fast leader and early to build out and scale and be able to pass LNG around the world very effectively. And it has a very low risk business model built around long-term contracts. It's essentially got a toll road plus kind of business model. So there's long contracts, lots of free cash flow, and the bits that are exposed to the upside of LNG pricing are finding margins going up. So it's in it's basically in the right place at the right time, given what is going on geopolitically. So LNG, as we know, is a kind of good transition fuel, and in the sense of decarbonisation generally, and there's a very strong demand for it, and it's just in a very, very strong position in terms of its business model and the fact that it can gather relatively low cost gas and liquefy it. So that one is kind of fits with general environment. You can see Airbnb we bought recently. We think this is an interesting business model. You know, we're all familiar with the Airbnb sort of app. It basically is perceived by the market to be a bit like Expedia and Booking.com, and really it's very different. It's got it's a very effective tool, both sides of the market, both for users and inventory suppliers, so people supplying the rooms and the houses. It's got very good software tools on both sides. Its customer acquisition costs are much lower than, say, for Expedia and Expedia and Booking, which obviously struggle with the fact they have to go via Google. So it's got a different margin structure, different free cash flow, and it's got revenue growth. But everyone is worrying about the consumer. But actually, when you look at the evidence, people are still basically very happy to go on holiday. And Airbnb is benefiting from that. So the business model is taking share. And it's more robust than the near peer group. So that's why that one fits the process. Netflix, slightly different, really. I think I spoke about it. There's an awful lot of anxiety about the business model change. Obviously, they're a bit of a COVID beneficiary two ways. One is the demand side, because everybody's stuck in, and we're very happy to watch Michael Jordan documentaries, or in my case, and obviously, so they had an awful lot of demand. But at the same time, their costs dropped because nobody can make any films. So they released a lot of free cash flow, had a lot of revenue growth, and then they hit that period when, in fact, actually we're all going to stay in Airbnbs and not watching Netflix quite so much. So they've struggled with user base growth and the fact that Disney Plus has emerged and a number of sort of big competitors. But the important thing is they have a really strong, massive global user base, and they're finding different ways to monetize it through an ads-based model. And so there's an awful lot of worry about this, but they have a very, very strong position in the sort of rebuilt bundle of TV that we all watch. They're a very strong back book and front book of sort of new content. And the ads-based model is causing a lot of anxiety amongst investors and analysts. But in actual fact, the last 50 years has demonstrated an ads-based model, once you've got a user base, is a really, really effective way of running a TV channel. So I basically see that as a sort of unusual degree of anxiety around it, that they'll basically be able to that will unwind as people realize they're able to hold viewers, and the ads-based model will be reasonably effective. So that's those four, quite interesting and all slightly different for different reasons.
Thanks very much, Ben. I saw quite a comical meme last week on Airbnb, an advert for 10 Downing Street saying it's ideal for short stays. But shuffling on for
sort of global embarrassment. There we
are. We can emphasize a little bit at times here. But on the detractor side, I think people are familiar with seeing Apple somewhere in your top detractors as well as your top contributors, given you'll always be significantly underweight on the position there. But again, like you've done for the contributors, any interesting notes, I guess, on these top four? The South African audience will be familiar with Capitec. Globally, obviously, Amazon and Tesla are pretty much household names. So high-level comments on these stocks?
Yeah, Capitec. I'll deal with the one that you will all be familiar with. More familiar with than I am. It recently disappointed, and it's done well. And it recently landed a little bit of a disappointment, basically from customer transactions were slightly lower than planned, so it disappointed slightly on that. But that basically looks explicable to us. Didn't break the investment case from our side. They deliberately lowered the fees on certain kinds of products to drive a bit more market share. And so, in the past, this has worked for them. So it looked like an explicable miss to us. And their strategy of lowering fees has been effective at basically getting higher income groups. So we weren't, obviously you're always disappointed the share price doesn't do well for you, but it looked fine. It didn't break the investment case for us. The other three, to your point, those are not local businesses. They're big global US businesses. They're still worth touching on because we do own them, but we're underweight because of our our way that our weighting system works. Interesting nonetheless, though, and the reason why they're interesting business models, Tesla, because it's vertically integrated. It's got an unusual control over its free cash flow and its gross margins. And that's why it's sort of doing unusually well in a difficult environment, I would say. There's a lot of focus on whether or not EV competition will basically catch up with them, and the worries about macro generally. But they're showing the vertical integrated model really works, and they have a lead there. Apple, basically, interestingly, because it's very resilient, and because it has this network effect of all of the physical things that like the headphones that I'm wearing, they're more effective in the Apple system. Outside of it, they don't connect so well. So it has that ability to keep on pushing up margins and prices there. And so it has detracted for us, even though we like it and we own it. Amazon, something similar, highly interesting business model with two bits that are, you've got the retailing bit, which is low margin, and the software bit that has incredibly high barriers to margin to entry now, and so very effective businesses. So those four, three of them did well, and one of them did poorly. The rest of the names are sort of more relevant in terms of the share prices didn't do so well. What you can see there, Tokyo Electron, which is a semiconductor equipment business. You will have seen, I'm sure, there's been incrementally worse news in various bits of the semis, partly because of the rules that have changed around being able to sell into China, and partly because there is a bit of a slowdown in creating memory chips and various other bits into the smartphone chain. So that's beginning to sort of worry some of those share prices. So we're taking a look at some of those that whether or not the anxiety is going to continue there. And then some of the software names like C3AI and UiPath. There's a lot of worry about macro going on around software names, and there's a bit of a debate about whether or not IT budgets are beginning to differentiate between some of the new SaaS businesses, the software as service businesses, or are they consolidating around some of the platforms? So there's some interesting things going on in software that aren't necessarily macro, but maybe more to do with the internal sort of competitive intensity of that market. So quite a lot of different things going on there, but actually overall for us, it was a reasonable quarter. We managed to outperform.
Yep. Thanks very much for that, Ben. You spoke a little bit about some of the risk in the system. I know you don't like to take too many macro calls. I think your September fund note spoke a little bit about relatively potentially sticky inflation, the risk of recession, etc. So for those invested in the fund, do you have any line of sight into how the fund may be positioned going forward, or at least potential changes in the future? Should we see a squeeze between growth and value at any point, or are you quite comfortable with that current dispersion?
The bits of value that we have, we think, are more positively exposed to the primary source of inflation, I'd say. So that commodity complex. So that if you worry about inflation, what you want is either you're a beneficiary or you have pricing power, so you can pass it through. And now, obviously, because we're bottom up, we don't sort of impose that. But the types of businesses that we find on the value side are more, I think, direct beneficiaries of inflation. And then on the growth side, things like pharmaceuticals, we've seen, they have a natural pricing power there. And similarly, things like Coke and Pepsi and some of the defensives that are able to pass through costs are the types of things that we're finding are more able to meet their plans and less likely to disappoint the market. And so most likely, to your question, what we're finding is more of those sort of analyst bias stocks with that pricing power capability. So the idea really is we want a portfolio that's resilient to macro shocks, and one of the possible sources of macro shocks is inflation, and hence we're piecing together lots of ideas that mean that it should be relatively resilient if inflation stays reasonably sticky, which it looks like it is.
Fantastic. We pretty much run out of time. 20 minutes absolutely fly by. Thanks as always, Ben. I appreciate your comments today and all the hard work you guys are doing over in the UK. And we'll catch up you, I guess, early in the new year for the Q4 edition.
Thank you very much for having me.